Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Brian Stutland, Managing Partner at Equity Armor Investments, as well as my CNBC contributor and YieldMax Strategist at YieldMax ETFs. We're here to discuss sector rotation, recalibrating Fed expectations, and if Bitcoin is signaling broader risk appetite shifts, and tech taking a breather a bit. Nasdaq was down sharply this week as investors reassess valuations ahead of Nvidia's earnings next week, which of course will be key. So the question is this a correction or a healthy reset? Brian, what can you tell us? What are you seeing within the volatility complex and the charts?
Yeah, I mean, I think when you look in the volatility space, obviously the VIX trading up above 20 here, some elevated concern, some fear out there in the marketplace. And that's really been led by the major tech, let's call it AI players in town, that have sort of seen a pullback, a little bit of a correction. And so there's been a little bit of, shakiness back and forth. When you take a look at the Nasdaq index, actually, that thing is traded back down to 25,000. And that's really a critical level for me that I'm watching. It kind of broke below there. We saw a reversal early in this morning, right off the open from the overnight markets, where the markets kind of rallied back, and now we're trading back above 25,000 here in the Nasdaq. And so that's really a level on a technical basis. Kind of looks like a little, what traders like to call a head and shoulders top, where you sort of break this neckline and then all support kind of just, crumbles below it. So, but it's hanging in there right now. So that's just a level I'm watching. And if we can kind of hang in there, then that should still be good news going forward towards the end of the year. But certainly the level of volatility in this marketplace is making things a little shaky.
Yeah, and of course, Mike, we have to address multiples and valuations. So the question is, are earnings multiples in tech sustainable, giving rising yields and Fed uncertainty?
Yeah, I think that, for the biggest names, they are. I look at names like Amazon. I look at names like NVIDIA. I look at names like Alphabet. I don't see these things as particularly expensive. They're not cheap, but I think they're very fairly priced. And as we think about what the rate assumptions that we're talking about are, and what kind of an effect that has as a sort of a discounting mechanism on future cash flows, the effect is still relatively modest, right? If we became concerned about big and steep increases in rates, that would be one thing. But I don't think that's really what we're contending with. I do wish the inflation picture was a little bit better, and I do wish we could get the front end of the curve down a little bit. I think that would probably alleviate some pressure in a couple different areas. And to Brian's point, just looking at the markets, I thought today was kind of a very critical test because, we're bouncing right along the sort of the 50-day weighted moving average. And I was really hoping we would see that bounce that we got today. We did. We did add some names yesterday, and we added some more this morning. I will say that we have been focusing on the higher quality types of stuff, though. So that means that we were adding to things like in NVIDIA, for example. So we were adding NVIDIA, we added some Salesforce, we had added some Costco, actually, and, which is more of a staples play. And we're reducing some of that really high beta stuff because the fact is we do have to acknowledge that some of these things are getting chopped up a little bit. And if we do break through, you have to sort of acknowledge what the risk of that is. And so I think it makes sense to sort of focus on keeping the core of your portfolio and some of the highest quality stuff you can find.
Yeah, and Mike, I think it's interesting that you're buying NVIDIA in front of the earnings print. Not necessarily NVIDIA specific, but there has been conversation in the marketplace around circular investment loop when it comes to chips and data centers and LLMs and so forth. Is that going to be sustainable?
Well, I guess it depends on what we think of sustainable. Are we going to be able to sustain the growth rates that NVIDIA has managed to accomplish and is forecast for next year? So what's the forecast for growth for adjusted EPS for NVIDIA for 2026? Full year 2026 is probably about 48% year on year. Is that sustainable in the long term? No, it's not. It's not for mathematical reasons, because if it was sustainable, NVIDIA would swallow the whole economy in just a handful of years. That's how fast that growth has been. So you can't expect it's going to continue in that way. But the other thing is it doesn't need to justify the valuation where it is right now, because it's probably in the high 20s of that forward multiple, or at least it was when I was looking at it yesterday. We did get a little bit of a pop. So it's not priced as if it's going to grow at 50% a year either. And I think that's the important thing. Amazon's not priced that way. NVIDIA's not priced that way. So, I think there are things that are priced that way. Palantir is priced that way, right? But we don't have a huge position in Palantir.
Yeah. And switching gears to the Fed, rate cut optimism for December seems to be fading. Treasury yields are holding firm, yet the MOVE index, Brian, which I know you watched and that tracks bond volatility, it remains muted. What does that tell us?
Yeah, I think when you take a look at this index, this is kind of an interesting one here, and I kind of have a chart on that as well. When you look at the bond move index, what that is sort of representing is volatility in the bond market, and what we've found actually as volatility compresses there means goes down, and there's less fear, there's less movement in the bond market. You actually find stock PE and ratio and valuations actually rise. To Mike's point, he's talking about valuations. Are they too excessive? Yeah, for maybe a few names, but also the level of liquidity in this marketplace is there to justify higher valuations, so to speak. And so, sort of as long as this move index kind of stays, kind of below these levels where we've seen it, it's kind of bottomed out. And since we got some rate cuts, obviously there's been some movement in volatility in the bond market. But as long as there's sort of a controlled rate cut here movement and the move index stays low, I think valuations to the stock market side, everything has a ripple effect to it. And I think stock market valuations can be justified on the higher end.
Yeah. And Mike, when you think about the policy and macro fundamentals, how do you break that down as you think about what could potentially happen in December with a rate cut?
Well, to me, really, it has more to do with the Fed's posturing than it does whatever they happen to do on the rate cut. So in other words, if we don't get a cut and instead we get some dovish language, that's sufficient for me. Because 25 basis points really doesn't make that much of a difference. And it really has more to do with, do we think that we are in a period of relatively easy monetary policy? And we have some indications of that even without a rate cut. And that is that we know that they've essentially allowed the tapering. And the tapering basically is the runoff, right? So you have the Fed's balance sheet, and some of the instruments on the Fed's balance sheet will mature over the course of time, as debt instruments will do, and that reduces the size. So if you take a look at the Fed's balance sheet, and you will see that it peaked, and then it started to roll over. And that was largely runoff that was taking place. And they were slowing the pace of Fed purchases, and they have indicated that they're not going to do that as aggressively. That is, from a monetary perspective, that is an easy monetary policy. So I'm not terribly concerned about it, I have to say. The thing that I'm going to keep my eye on most is inflation in the U.S. If the inflation picture is bad, that's grim. And the other thing is labor. So really we have to think about the things that drive it much more than we have to worry about like a 25 basis point cut one way or the other.
Yeah. And Mike, to wrap up here, I want to talk about Bitcoin for a moment, losing ground again. And that was once seen as a leading risk on indicator. And I would argue that some of its volatility could be idiosyncratic. There was so much momentum coming out of the passage of the Genius Act. We saw more product and more institutional adoption and interest in it. We're seeing that brain drain that left the US coming back, reopening offices, establishing footprints here. And I think some of the momentum could be in question with the government shutdown. And we really need to focus on the Clarity Act now. That's the market structure part. And that's what's going to be key going forward. And I think some folks within the digital asset space, not just specific to Bitcoin, but the space in general, that could potentially be an overhang. But the broader question is it still relevant? Do you think it correlates as much as it does with the risk on mentality with that in mind?
Yeah, I would offer two things about this. So the first is I think that in the long run, I'm still a strong believer in the space. We have a lot of exposure to it. We have less than we did the last time we spoke. And that is really a function of money flows. And that is if we find that there's a lot of weak hands that are getting flushed out or that are being forced out, we have to acknowledge that. It's not a great technical setup. It was not a great technical setup the last time we talked about it. And I really want to see some of that, strength return to it. I will make this point because I think it's kind of interesting. Strategy hit a 52-week low today. And as people look at that one, when you start to see Bitcoin stabilize, so basically it's below its 50, it's below its 200, well below in both cases. But if you start to see it stabilize, it starts to even out at the bottom. Strategy has about 640,000 Bitcoin on their balance sheet right now in round numbers. We just like to use back of the napkin. Saylor was on TV earlier today saying that he's adding aggressively. And probably about $10 billion of their debt instruments are convertible. So if we add the market capitalization to that 10 billion, basically you divide that number by the value of the Bitcoin that they have on their balance sheet. And that's kind of the multiple that we think of, the premium that you're paying when you buy Strategy relative to their Bitcoin holdings. Otherwise, you're basically getting it at fair value. You could liquidate the business and you know, take the cash. So we're getting close. It was down to about 117% of their Bitcoin holdings when I was looking at this recently. So if you start to see Bitcoin level off and you're inclined to make a play to the upside, I think that's going to be a decent place to play at probably 1.1 times or less, and it looks like it's going to go there.
Yeah. And Brian, to wrap up here, what do you think about Bitcoin's price action specifically? Does it still correlate with tech or liquidity cycles? What are you seeing from the chart perspective?
Yeah, I mean, we have some models where we look at Bitcoin and we kind of see the momentum trade on that. And really, when you look over the last couple of years, it's been a very good leader indicator on where the markets are going, meaning that Bitcoin trading above its 50-day moving average has really been kind of a bullish signal for the rest of the markets to sort of follow, and vice versa the other way. And when you look at the technicals, Mike brought those up. I have a chart here on what Bitcoin looks like, and it does not look good, I got to say. So, like, you know, you're kind of seeing this topping pattern come out here in Bitcoin right now, falling back below 100,000. There's definitely some weaknesses there, and I probably wouldn't really be a buyer unless I see it get back above 100,000, get back above that sort of neckline formation that it broke below. On a technical trade basis, that's probably an area where now that's going to become resistance rather than it was being support. And so there's some weakness here. But to Mike's point, I think he brings up a great point on Strategy, because that is trading now like 1-to-1 book value. And so that might be a great way to play back to the upside if you're inclined to sort of step in here. But certainly, you know, the level of volatility we're seeing in that is a little bit concerning, because it has been a leading indicator of the rest of the market and risky assets. The fact that it's not trading so well makes me a little cautious. That's why I want to hold some hedge, hold some volatility as we do in our portfolio. We did some rebalancing today, you know, as the market sort of ripped around from last night back into this morning. But certainly, when I'm watching this as what's been a leading indicator, it's got me a little bit concerned. It's got me a reason to sort of hedge and watch my caution. It's probably why Mike's group, you know, maybe, you know, lessened the load a little bit on some risky assets, some of the big growth names, and made a rotation. We're seeing that in the marketplace. Value names doing very well in the last couple of days relative to the rest of the market. So it'll be interesting to see if that continues, if Bitcoin continues to show some weakness here.
All right, Brian, Mike, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.